Hey guys, what's going on? It's Lewis here with Crypto Elite, and this video is going to be an educational one on the basics and fundamentals of trading. In this video, we're going to be going over market structure and order blocks. These are two concepts that are very crucial when it comes to trading, whether you're trading cryptocurrencies, Forex, stocks, or other instruments. These two things are used by many different traders, and it is something that I personally use as well. And so let's get into it right after the intro. So what I'm gonna do is draw out a potential chart right here. So let's say that this is what the price is looking like. Let's say that the price looks something like this, right? Well, what this is obviously this is an uptrend. And there's a few different ways that you could determine an uptrend. Some people like the moving averages. Some people like the, I don't know, there's a million ways. Just looking at the fact that it's higher lows, higher lows, higher lows, higher lows. And then there's also the market structure way, which also has to do with higher lows and higher highs. So we could see that it started out here, went up, created a high, created a low, aka a higher low. And then it broke above the previous high right here. So once the price breaks above the previous high, that right here, this is a market structure break. So I'll label that as an MSB, a market structure break. So it's breaking the market structure to the upside. It's breaking through the previous high to the upside. Then the price came down and it did not go down below the previous low, right? It stopped and reversed above the previous low. So there's no market structure break because the market structure is continuing upward. It's staying in an uptrend, right? So we have this original market structure break right here because it came above this previous high, and then it came back down, it retraced a little bit, and then it pumped up again, and of course had its second market structure break right there. So we'll label this as market structure break number 2, right? So it came back up above the previous high and it broke the market structure. Then it went down, created a higher low, a lower high, and right here, this first higher low, this low is higher than this low. So obviously it's a higher low. So there's no break in the market structure. Then it created a lower high because this high is lower than this high. There's still no break in the market structure. This right here does indicate that the trend is getting weaker because remember this one right here, this just went straight right above the previous high, and this one right here went straight above the previous high, and now this one did not go above the previous high. So that's indicating that there's some weakness in the market. And then it did have a move down and it broke through the previous low. So this low was a lower low compared to this low. So now we are in a downward market structure. We had a bearish market structure break because we created a lower low. So this one right here was not a market structure break because of the fact that we had a higher low, and a higher low. But then we got our first lower low. So this lower low was a market structure break of the previous low to the downside. So it's a bearish market structure break. However, you can see that that did not last very long as the price reversed and went straight through this bearish market structure break. And it'll make more sense if I do this actually. And then the price came back down, created a higher low, and then another higher high. So where do you think, can you see where the market structure break is right here? The market structure break for this move up and then this move up. Well, for this move up right here, we had a market structure break right here because this was the previous high and it created a higher high. So we have this market structure break, and then on this move up, we created another market structure break right here when this higher high was broken, right? Okay. So that's bullish market structure breaks, and then the bearish market structure break right there. And that was mostly in an uptrend, right? So in a downtrend, in a mostly downtrending market, we have a high, a low, a lower high, and then a break down in the market structure. So a market structure break from this previous low to this new low. So we made a lower low. So that's a market structure break to the downside, a bearish market structure break. Then we created a lower high and then a higher low. And neither of these are market structure breaks yet. But once we break above this previous high and we create a higher high, now we have a bullish market structure break. But in this case, the bullish market structure break did not sustain itself in the bullish narrative or the bullish trend, and it reversed and it came all the way back down, and it created a lower low from this low. So once this broke right here, now we have a bearish market structure break, and then we made a lower high, and then we created another bearish market structure break. So this is what the market structure breaks are on the bearish end of things. Okay, so the next part of the lesson I want to go over is called order blocks. So order blocks are areas where you tend to want to get into trades, and they happen at very particular areas on the chart. So in this example, in the bullish example, you could see that the price, it moved up. And while the price moved up, a lot of retail, or a lot of dumb money, I guess you could call it, start buying at the top, or start buying here and here and here and here and here and here. It's at this point that smart money or big money tends to start to sell, and everyone who bought down here starts to sell. So they'll sell right here at the top, and they'll continue to sell. And then once the price retraces down to around this level, this is when the people who were late to the party on this move up will start panic selling, and that will drive the price down. And this move down right here, this is where a lot of the big money who originally bought here and then sold here, they will buy back right around here. However, a lot of times there's not enough liquidity for them to buy back their full order right here. So they need the price to eventually come back down to this area so that they could get their fills back. They could fill up their orders even more. So what happens is they start filling their bags, and then the price, eventually they end up buying so much, but they buy so much and there's not enough liquidity that it starts shooting the price up, and the process begins again where retail will say, oh, the price is moving up, and they start buying and buying and buying and buying and buying and buying and buying, right? Then right here, more big money starts selling, but they don't sell as much, but they still move the price down. And once the price gets down to where they originally started to buy back down here, that's when they'll put in their big order. And then it'll usually just shoot the price up. So that's why, well, I don't know if that's why, but this area right here, the down move before the up move up, basically the down move where the big money starts to buy in and then eventually shoot the price up, that is called an order block. And the order block is usually where you want to get in when the price makes a market structure break to the upside and then starts to retrace back down. You usually want to get in at the top of the order block before the market structure break happened. So that is why you would put an order in right around here, like in this level, basically. Let me just do this, basically like this. And you could put your order in here. You could put your stop right underneath the order block, and you could target, if we're in an uptrend, you could target the high and then above the high for a really good risk reward and a good trade. And to add more confluence to this, one thing that you could do is you could plot out the range from the low to the high and then target the midline or target the 61.8. In this case, the range from the low to the high came back down and you got in at the midline. Or let's say that you see that this is the range. You can plot this out and then target the 61.8, get in at the 61.8 if this is where the order block resides, or if this is a big support area or something like that. So this is like a big rundown on order blocks. And so let me go into the bearish order block scenario. Okay, so for the bearish order blocks, what could happen is that the price will dump, and then the big institutions or big money or smart money will start buying, and then they'll get the retail very excited, and retail will start to buy in, and then the big money, smart money will just dump all of it, and it'll just crash really, really, really hard. And then they'll start to buy back in down here, right? They'll start to buy back in down here, and the retail at this point, maybe they're like, oh crap, like it's dumping, so we don't want to buy it. We don't want to buy it. So the big money, smart money will sell it off, and then retail will be like, oh great, like I'm so smart, and then the big money will start to buy it back in. And as they start buying back in, now retail is like, oh shit, maybe I'm going to miss the boat. Maybe this actually is going to be a reversal. So then they start buying in at the, up here at the top. They buy. And eventually big money who sold right here, who bought right here, and who bought right here and bought right here, they end up just dumping all of it and having a huge market structure break to the downside and huge sell-off. And so that's the general gist of what's going on here, because they need the liquidity from the retail and from the buyers. They need that liquidity in order to sell. And they also need the liquidity just like how they need the liquidity in order to buy. They need retail to sell down here so that they could start buying. That's the purpose of these order blocks. So the order block for, let's say, the up move, the order block, the bullish order block is not the up move, but actually the down move before the move up that breaks the market structure. And so that means that on this down move right here, let's say there was a down candle right around this area. This down candle happens, and then a bunch of green candles happen, and it creates a market structure break. Well, that down candle, that last down candle, is the order block. So that's a bullish order block. A bearish order block is the up candle, the last up candle before the move down that breaks the market structure. So in this case, the order block would be somewhere right around here. It would be this last push up, basically, by retail. This last push up before the market makers push the price back down. And the market makers push the price back down. And when it comes to bearish order blocks, a lot of the times the price doesn't come all the way back up to the bearish order blocks, because basically the market makers, the big money, they could sell a lot, right? They could just sell. And yes, they do need people. They do need people to buy in order for them to sell, but they could essentially just keep on selling and get a lot of and get some slippage. They could essentially just sell and get some slippage. However, if they're going to be buying, they really need people to sell, right? They really need people to be selling into them, to be selling into their buys, because the slippage would be much greater on the moves up for them to just buy. If no one is buying, if no one is selling, and you want to buy like a lot, well, you're gonna have to you're going to have to freaking buy so much. You're going to incur a huge slippage. Meanwhile, if you're trying to sell, you could sell a lot and the slippage will definitely still be there. But a lot of times what happens is that people, they get scared and the price doesn't always come back up to the bearish order blocks. However, when it does, it creates amazing shorting opportunities, which is why you need to know about it. So let's just say that this right here was, and I hope that wasn't long, that was long-winded, but whatever, I'll keep it in there. This right here is the move up before the move down that broke the market structure. So this is the bearish order block. And you can see that the price comes back into it, creates the sell. So what you would do is you would put a sell order in right there with your stop above here, and you would target the lows, and then even that would be target 1, and target 2 would be underneath of that as well, because you're looking for a continuation. Order blocks, market structure, this type of trading is trend trading. So you're looking for the trend originally, and you could see, oh, okay, the trend is moving down. So you want to go with the trend. You want to make sure that you put a short position in and go with the trend. And obviously when the trend is going up, you say, oh, I see that the trend is going up. It's making higher highs. So on the higher time frame. So, and it's making higher lows on the higher time frame. So I want to go with the trend. I want to look for longs in this scenario. I want to look for shorts in this scenario. And so that is pretty much order blocks and market structure. And one other thing to look out for, or one other thing that you might notice, is that down here, this right here, this area, this you could say is a support area. So you can label that green. So this is support that, or demand. I think it's more technically called the demand zone. Actually, I don't think like it is. It's technically called the demand zone because there was only one touch on this particular diagram. So this is the demand zone. So there's a lot of demand somewhere down here in this zone, and you can see that touches the demand zone and then shoots up. Down here, up here, this is there's a lot of supply. There's a lot of supply up here because there's a lot of people that sold, there's a lot of people that bought right here, and they want to get out. They want to get out as close to break even as possible. So when the price comes back up to this area, there's a lot of people that are scared and they want to get out. So that's why this is the supply zone. There's a lot of supply up here, and that is confluence of the order blocks, right? And just how like this demand zone down here is a confluence of the bullish order blocks. So we have that, and what you could do is you could just look at this, right, and say, okay, I'm gonna sell here if it's bearish, and if it's bullish, I'm gonna be buying here, right? So that's one way to do it, but you could get a lot more technical with it. You get more a lot more specialized or precise. You get a lot more precise with it, because let's say that this is the 12-hour time frame. What you could do is you could zoom in on a lower time frame, and maybe on a lower time frame, if the price comes up here, maybe the price will do something like this. It'll be coming up, right? It'll be making higher highs, and then like it'll make the higher high right here, which will be this point right there, before coming down and making a market structure break, making a market structure break on the lower time frame. So let's say that this is 12-hour, let's say this is the 1 hour. So what you could do is, instead of on the 12-hour time frame, say, okay, I'm going to put my short order in right here. I'm going to target right here, the low, and I'm going to put my stop, above this 12-hour order block. What you could do is you could zoom in to a lower time frame once the price reaches this area, and you could look for something like this to happen, a market structure break to the downside. So you could see that it's making a higher high, higher low, higher high, higher low, higher high, and then finally a market structure break to the downside by having a lower low and then another lower high. So I'll just label that a market structure break. And then what you could do is you could put on a short position something, something like this, which this is a 3.31 RR. This is a 3.31 R. This is only a 1.97 R. So you could get a lot more value out of your trade by going into the lower time frames in this zone, in this supply zone, this 12-hour order block, this resistance area of interest, whatever you want to call this red box right here. That's what it is. That's the area that you zoom into, or you can zoom into if you have the time. When the price comes up into this area, look for something like this on the shorter time frame, on the lower time frames, and then get a much higher risk to return ratio. And that's on the downward side. That's on the basically when the price is going down, it's trending down. On the bullish trending, when things are trending bullish, you could do the same exact thing. So let's say that the price comes down into this bullish order block, or this demand zone, or this area of interest, right? What you could do is, instead of putting on a trade, whoops, I don't know. Why does TradingView do this sometimes? Why does it have this go all the way there? Anyway, instead of putting on a trade like this, right, where let's say it's a 1.3 R, or maybe actually you would want to, let's say you do that as a 2.3 R. What you could do is you could set alerts in this area. And if you see the price come down into this area, and let's say on the 1 hour time frame, it's coming down, it's coming down, it's coming down, right? And then you see it do something like this. Okay, you see that it changed course. So if I get rid of that, I could do something like this. It's doing this on the lower time frame, right? It's going up, down, up, down, up, down on the lower time frame. Eventually it's going to change course on the lower time frame and start moving up in the same trend as the higher time frame. So if you zoom in on the lower time frame and you see something like this, now you could take your stop loss, and instead of putting it underneath the order block on the entire high time frame, you could actually zoom in and just put it underneath the low time frame, the low that came on the low time frame before the market structure break to the upside when it started to reverse. And that obviously gives you a much better risk to reward ratio. And so those are the basic rules around market structure breaks, and order blocks. I hope that this video helped you out in your trading. If you use this style of trading, let me know, or if you want to use it, let me know. I will have a lot more educational videos coming up, and I hope you continue to practice, get better, improve, and just learn as much as you can. Also, if you want access to my free Discord group, I'll have a link for that in the bio, where I like to keep people updated on my general views of the market, along with Bitcoin and Ethereum. Also, if this video was helpful, please give it a like, a thumbs up, and a follow, because it really helps me out. And finally, if you could follow me on Twitter, that would be pretty cool too. I'm trying to get my stats up on Twitter. So I'll talk to y'all later. Keep on stacking those sats, keep on making those gains. Peace.